Okay, good morning, everyone. Hope everyone had a great week so far. It's a beautiful Tuesday. Just wanted to first introduce our speaker today. We want to first thank him for his time, Matthew Mundell from Fidelity and Guarantee. He's the internal wholesaler. He's going to go over today the basics of the annuity programs that many of you have heard of before. But I think it's important that each agent in the company get a chance to review and understand the power of the FG annuity. And if there's any questions, you may want to type it into the question section, and then Matthew could answer that towards the end. Okay, so go ahead and, hey, Matthew, it's all yours. Matthew Mundell,
thank you.
Fidelity and Guarantee.
Thank you. Yeah. Can you just confirm, you can see a screen, it's about half yellow, half white for you?
Yeah, I see the whole thing. It's perfect.
That's the one. Okay, cool. So thanks for the opportunity here. Again, I'm the internal wholesaler for you guys moving forward with kind of a national footprint. I'll explain that in a little bit here. But I want to talk about, I'm going to briefly go into our how F&G operates as a company, what our advantages are in that regard. And I'll talk about three specific products, kind of our flagship products: Power Accumulator, Accumulator Plus. Both of those are accumulation products. They have accumulation solutions. And the Accelerator Plus, which is our flagship income product, very, very popular. So without further ado, let me just jump on in here, make sure this works right. I'll talk about the agent portal as well, briefly. So again, not to spend too much time on this, but these are the rankings from last year. We've seen an increase in rankings. We have a new parent company, actually. I think a couple things to point out here. As a company, F&G is now number 3 in the IMO space. We're shooting up in production. We have seen a lot of premium flow our way, a lot of new agents flow our way, a lot of people, new producers, just because of the strength of our products, and people have learned to trust F&G. Oh, yeah, this is it's actually outdated with the 2019 numbers. I apologize. Rankings are at least a year old. We have a new parent company. One thing to keep in mind about that, we have a client talking about, who is F&G? What is this company? The largest title company in the world, called F&F, down in Florida, is actually our parent company now. Okay, so one thing to keep in mind about that is typically in the annuity, life insurance industry space, you think, well, when interest rates are low on the federal level there, it's going to hurt, the annuity carriers and insurance carriers. The cool thing about our parent company is, they are very mortgage rate driven on their profitability. So they are just having a crazy run here. And the good thing is that is a good counterbalance to, a low interest rate environment for them is a totally different ballgame than it is for us, right? So it's a very good counterbalance. We're extremely happy to have them as a parent company. I think that's part of our strength as well, is it gives us the working capital to make our products rich and keep our products competitive in the marketplace. Blackstone handles our separate account here at F&G as an insurance company. I don't want to get too deep in the woods. I don't know if everybody on the call is familiar with how that works, but essentially they handle our investments, the capital that we have, to get a return that can support our products, and they're really the best in the industry. They've done an excellent job for us. And we really have, and I'll kind of point at this a little bit, and you'll understand this as you work with us moving forward. But we really have probably the best sales team in the entire industry. It's very lean. It's very lean, so that means that we are not siloed. We don't have very specific job functions. We are resources for you as producers that other companies aren't able to provide, because their sales team might be very, very focused on one thing. We have a very broad, I speak for everybody here, we have a very broad base of knowledge about our products and how the company works, and also how the industry works, just based on the size of the sales team. And that is really, I think, our competitive advantage. Now, I'm going to show you, my slides must have got out of order here a little bit. I apologize. Well, for some reason, the slide isn't showing. I was going to show you a picture of myself and kind of how our territory works, but just know there's 9 of us, and we're building out a sales desk as well. So if you think about the amount of premium we do, 9 people. We're a different breed, I would say. So I wanted to kind of split up a little bit how our products work. Generally, our annuities are accumulation and income based. We have a wide variety of annuities. We have a newer product I won't have time to talk about now on this call. It's called the Flex Accumulator. It has a very competitive death benefit. We're starting to get into that space as well. So we really have a solution for all of your annuity needs, and in my opinion, for any client need You know, even clients that particularly would kind of raise their nose up, put their nose up at annuities, I think we have a good solution for them. We have a lot of business coming from first-time annuity writers on the agent side and producer side, and first-time annuity clients on the client side. Let me just make sure this, there we go. So I want to talk about, this is our #1 product by a long shot by volume. It's our, historically, it's been our flagship. It's called the Accumulator Plus. I apologize, my thing is going wacky here. I apologize, Jeff. I'm having issues with my PowerPoint here. You know, one thing to keep in mind when I started about talking about this, I want to just talk about a little bit about what kind of clients you can go after with our products, right? So we have indices that kind of mimic funds, mutual funds, more actively managed investments in the market. They provide a couple things that you can't really get anywhere else, right? One is, the big one is there's a guaranteed zero floor. So clients are not going to lose money in our products. They invest their money with F&G. And there are things like income riders, death benefit riders that are not available to clients that typically would be investing directly in what we call the market, right? And that's a broad statement, of course. There's bond funds, things like that. We see a lot of money coming over. We're thinking about clients, we're talking to clients from bond funds, from more conservative mutual funds, which of course do not have a 0% floor. Of course, you can lose money on there. Variable annuities, we don't sell variable annuities, but we get a lot of premium coming our way because of the high fees that you see. You know, you think about the fact that, except for the income riders, especially on our accumulation side, you're not going to see any fees unless the client opts for them. You think about how powerful a story that is for your clients to say, look, I have this investment for you. It's historically done very, very well. There's going to be you're never going to lose a dime in it, and it has no fees. Right? That is a very, very powerful story, and something that fixed index annuities, especially at F&G, can offer that, and it's not offered anywhere else in any other category of product. I think bank accounts, one thing to think about. CDs is a big one. We're able to provide, CDs they're not performing very well. Typically under 1% yield on those. Something to think about when you're talking to clients about where they might have their money located. Those very conservative investments, our portfolio is an excellent place to place it. So Accumulator Plus, what you're looking at right now is just our at a glance here. Kind of breaks down minimum and maximum ages for clients, minimum premium. I do need to say, I want to mention this, $10,000 is the minimum to get into one of our annuities, and $2,000 at a time is the bare minimum to buy in. So we get a lot of requests. I want to mention this because we get a lot of requests to do like monthly contributions of $50, $60. We're just not set up. It's not, from a profitability standpoint, it's just not there. So we require $2,000 at a time. Now, for some clients, they're able to get that by the end of the year, in the anniversary of the annuity. So it's actually not, there actually are some benefits to doing it that way, but just a heads up, if a client is looking for contributions on a monthly basis or quarterly basis that are below our threshold, we would not be able to accommodate. So I want to make sure I point that out. We get that request a lot, especially IRA contributions, things like that. And another good thing about our products is after the first year, most of our products, there's one in particular we won't be able to touch on now, but most of our products, after the first year, you can take 10% of the account value out. So you think about what the account value is. If it's grown in that year, our client's going to be able to access that money as well. That is an advantage, obviously, over a CD, right? I mean, you're talking about, I don't mean to focus on CDs here, but you're talking about a extremely conservative investment. The client's locked in for a period of time. Our fixed index annuities do give them some flexibility to access their capital. A lot of clients do, they will just take out money, take out the growth in the account and leave the initial premium in there. That's one way to do it as well. So I want to talk about the participation rates on the Accumulator Plus. We'll talk about this Barclays Trailblazer, which is the flagship index for us. Moving forward, our client has an option here to, on the left-hand side, you'll see what we currently offer for a no fee option. So it would be the client doesn't pay anything. They just get whatever you see there. And on the right-hand side, you'll see 1.25% fee options. What that is on the Barclays Trailblazer, I should say it's a 2-year strategy. What that would be, excuse me, is say it's February 23rd, 2021, client's account opens today. you would lock in the amount that the Barclays Trailblazer is at today, that index. February 23rd, 2023, 2 years from now, you take that index. Hopefully it's grown. Again, there's no downside. If it went down, the client's not going to lose money. There are some advantages to that we can talk in the Q&A session. So the client will get 160% of however that's grown. And the cost for that on a 2-year strategy is only 1.25%. How that works is at the beginning of the 2 years, so 2021 here, February 23rd, 2021, the client would pay 1.25% of the account value to F&G to get an extra 40% of upside, we call it alpha, right? The way we do it and why we're different is because most carriers are going to charge you that fee on an annual basis. On a 2-year strategy for us, that fee is only charged one time, right? So the client is going to get an extra 40% upside if the index performs over the course of 2 years. For, the math is off, 62.5 basis points, 0.65% per year. That is substantially lower than any of our competitors, and it's really not how most of our competitors work. Most of them, you're going to see a 1% or more fee on an annual basis, even on a 2-year strategy. So please keep that in mind as we walk forward. That's one of our kind of hidden secrets. I'm going to try to insert those here to give you an idea of how we're positioning where we win in the rest of the presentation here. So again, please ask any questions while we're moving along here. I have a lot to cover. I want to make sure we have time for Q&A. So I want to talk about this Barclays Trailblazer now. This is actually, it's a multi-sector. I don't get too deep in the woods on this, but it's a multi-sector index. It tracks 14 different sectors, basically ETFs, in the marketplace, in the American and partially the world economy. And there's a cash component too in times of high volatility. You can think about it this way. Every day, it looks at a combination of all those 14 plus cash items and says, what is the best way to increase the value, if there is any, of this account, of the Barclays Trailblazer, without exceeding a 5% volatility target? And that's what that 5 means on it. Now, I should say, before we circle back to that, this is, you see on this screen, an award-winning index, and it has, I believe it's still the number one index in the entire industry. The amount of money that's flowing into this index because of F&G's partnership means that it is by a wide margin the most popular index in the market today. The way it works, essentially, I'm not to get too deep in here. Harry Markowitz came up with this modern portfolio theory back in the 50s. Again, potentially rebalances on a daily basis and looks at all the combinations. It does like 5,000 to 15,000 calculations every day at the end of the trading day, and says how, with a 5% volatility target, how can I increase the value of the Barclays Trailblazer? To be honest, that's how all of these work. It's just ours has been more successful. It's the way it's set up. So here's what it tracks. To give you an idea, this is really kind of all over the place as far as covering the entire economy. When this index came out, it was groundbreaking. It's been often copied and imitated, but it is one of the top performers in the industry still. So you can see what it does is you think about it in terms of existing, more traditional investments, a blended fund, a multi-sector fund. It mimics that, provides a volatility control number of 5% on it, and offers no downside to the client. Right. So a lot of these multi-sector funds, I know because I have some that I'm invested in on the mutual fund side, have gone negative. Right. The client is not going to lose money in this type of investment. When they put their money with F&G, even if this index goes negative. There's a lot of levers there, as you can see. It's very conservative bond, real estate. Obviously, in some cases, one goes up, the other goes down. Right. So there are times when what happens in the overall economy will hurt one portion of this and not another, but that's where the rebalancing comes into play, right? Where if equity is doing great, and real estate is not, there's multi-sectors in here for it to rebalance and kind of move to provide what we call alpha or upside for your client. It's one of the advantages of this type of index. This is at the end of 2020. So even after everything happened in 2020, all the crazy volatility, clients who had theoretically had a 2-year renewal in this product would have received, so again, this is a multiplier on here, 15.41% and then multiplied by the participation rate, right? Those are returns honestly, that you can't really provide outside of hedge funds, without having a lot of downside. So very, very fantastic. Again, this is ultimately a conservative investment in a fixed index annuity. There's no downside. The client is protected, the premium protected. We're still able to offer really awesome historical returns for your client. This gives you an idea here. So the first two arrows, this is from an illustration we ran it back in January. First arrow here on the left side, $100,000 original investment in this product. Historical returns would mean, and of course the last 10 years might not be repeatable, right? Historical returns would show after 10 years, client at the age of 72 has $219,832. They're starting to take RMDs in year 11 here. You're talking about a client who, if you look at the left-hand side, the orange box, client who after the end of the next 10 years has taken out $115,933. The account has surpassed, the account growth because of that Barclays Trailblazer in this scenario has surpassed the amount of the withdrawals for the RMDs. Client still has, if you take your eyes all the way to the right there, that yellow arrow. In this scenario, this type of performance that is possible, the client would still have over $300,000 in their account if they passed away at the age of 82 for their beneficiaries, the loved ones, for charity, even having taken over $100,000 of RMDs, right? That's the power of these products for long-term planning. Something to think about moving forward is trying to choose one that will perform and outperform the money that's being taken out. So this is something that people do a lot. They'll use this as kind of a de facto, like using it for RMDs. De facto, we'll talk about income riders in a second, but they'll use this as a way to almost act like they're funding their own income product. And here's a range here. So obviously our illustration is going to show the most recent range, 10-year bull run. Look on the left-hand side. It's going to show about 8.2% geometric average annual growth rate. Again, that is a compounding number. So you take the first number multiplied by 8.2, multiplied by 8.2. It's not a simple average. So it actually is better off for the client. The low period in the last 20 years, it also illustrates 2005 to 2015. Again, this gives you a range of what that index has done, the Barclays has done. I will be honest with you, the expectations of fixed index annuities is conservative, especially with what they're replacing, CDs, very conservative bond funds. Anything above maybe 4% is you'd absolutely totally smoke the market, right? Now you're talking about an average, even in a down 10 years, you're talking about an index who's done 5.5% compounding every year in the worst case scenario. So not worst case scenario, I shouldn't say that. Worst case would be 0, but the worst 10-year run in the last 20 years. So yeah, you can kind of see the range here of how it's performed. Both of those numbers, fortunately, are very, very compelling. Let's see if I go to the next slide here. So I want to talk about a newer product. It is an even simpler story. We talked about how the Barclays worked, 15 different sectors. This one's called the Power Accumulator, and we'll talk about kind of how this works right now. This is, I think, going to be the flagship moving forward. The way it works is we leverage the BlackRock name. What it does is it tracks BlackRock ETFs, iShare ETFs, which something like 20% of all investors have a BlackRock ETF or have in the past. ETFs are very popular. You're talking about 30–50% of clients, depending on the age that you'll be talking to, probably already are invested in ETFs. They understand how they work. They're trackable, super transparent, very simple to understand, right? So we've been very fortunate to have this relationship with BlackRock and their expertise. So the crediting options that we offer in this product, no caps, participation rates, spreads, no annual fee. Again, we did just add an annual fee option for the buy-up though. I think we need to get these updated with compliance, but for the buy-up option. So again, the client's not going to lose money. They're getting access to the BlackRock name ETFs without annual fees. They're not going to lose money in our product. The only time they'd ever see their account value go negative, maybe only temporarily, hopefully, is if they do the buy-up option like we just talked about. Trackable and transparent. I was just talking about that Barclays, 15 different sectors. This one is much, much more simplified, as you'll see in a second. And there's about 30 years of history for each of these ETFs. And again, benchmark to real returns. And you're talking about, it doesn't get much simpler than this in a fixed index annuity to be able to explain to people how their crediting strategy is going to work. Clients can pull up these ETFs at any time on Google, Bloomberg. and they can get values, kind of get an idea of what they'd be credited. Principal protected, right? 0% floor. Tax deferred is, really a feature of all fixed index annuities, and one of the best parts of fixed index annuity. Certain guarantees on especially the zero floor. And then again, we offer liquidity on our products, 10% liquidity after the first year. It's pretty standard across the industry, but especially with a very high performing index like this is kind of a slam dunk as far as getting tax deferred growth for a client. So 2 ways to slice this, basically. There are ETF options. We'll talk about it in a second. And then we have a blended index that is going to rock star. We'll kind of talk about that in a little bit. A 5 and a 10% volatility chassis. Technically, right, these indexes are, these strategies are uncapped. Participation rate, the percentage on any positive growth. And again, I cannot express enough to you why this is such a popular product and becoming such a popular product. It's so transparent. It's very easy for clients to figure out how it works and to go on to, like I said, Bloomberg or Yahoo Finance and find out historical performance. Same $10,000 minimum. One thing I forgot to mention though is we do have what's called an Mba Rider on ours. So for certain confinement, nursing home, home confinement, 2 out of 6 ADL. Sometimes some companies call it an ADL rider. Clients can access their entire account value without penalty, right? So if certain criteria are met and we approve it, they'll be able to liquidate the account without having penalties. So that becomes very important if a client really truly needs the money and say it's year 4 of their contract, of a 10-year contract. And typically they will be hit with a surrender charge on that money if they're taking more than the 10% out a year. What we do is we allow them under certain criteria to liquidate the account, totally just close out the contract, take any growth in the account, take it as a lump sum. They're free to do with it as they wish, right? Very, very important feature. A lot of companies will charge an extra charge for it. We do not charge for it, just built into our products. These are the options here on the ETF side. We got S&P. The EFAE is a Europe, Africa. That is a Eurasia. That is an international ETF. You have real estate, and then you have gold trust. And you can kind of see on the right here how many years they've been available. So you're talking about something that is not. The problem with a lot of fixed index annuities is the indexes and the way the money is being credited is very, very opaque, right? You can't tell what's going on a regular basis. Not so with this platform. Now, the kind of rock star on this is the Balanced Asset 10 Index. What that does is it is a 60-40 blend of those two that you see right there, those two ETFs, iShares, IVV, which is a core S&P 500 ETF, and the TLT, which is a 20-year Treasury ETF. So a 60-40 blend is basically like, you may hear like a balanced fund or like a moderately conservative fund. The 60-40 is a very, very popular blend, especially for investors who are of the age to be interested in fixed index annuities. That's really the power of this one is from a storytelling standpoint is that you're able to offer something that really kind of, honestly mimics a little bit what your clients are already invested in. They're probably already invested in. This is a screenshot of the options here. Just wanted to outline. So remember, there's no downside, right? So you're offering. Stop at the top, right? Sure at the top, right? Our short is core S&P 500. 1 year point to point gives you 23% of the upside. If we look all the way to the bottom here, like again, this is the rock star on the bulk of our pricing power is. You're seeing the Balanced Asset 10, that 60-40 blended index, 42% on a 1 year point to point, and then there's a spread on the 2 year. You'll get 100% of what's left after 5.1%. Think of it like as a hurdle. Spread is like a hurdle. Let me pull up some numbers here to tell you. If I can, if my computer will work. I wanted to tell you kind of what that's done historically. It should kind of blow your mind here. So on the 10-year product, the 2-year strategy, you see at the bottom there, 9.22% is the compounding average, right? Even with that spread taken out. So that means the client who would have hypothetically been in this product for the past 10 years would have seen an average compounding interest rate credited as 9.22%. The one right above it with the 1 year point to point It's 5.51%, which is still absolutely fantastic. And you got to think that's also, they're seeing crediting every year. These are numbers that any insurance producer should be salivating over, to be honest with you, because this is offering a lot to clients that they can't get anywhere else. So let me just keep on moving here. Talk about the balanced asset tail a little bit more. Cool thing about this one is the 10 on that, just like the Barclays Trailblazer 5, the 10 on this means 10% volatility target, double the volatility appetite, is what I like to say, of traditional indexes, right, like the Barclays. To give you an idea how that works, because of the volatility in 2020, the Barclays and most 5% indexes that were designed correctly had to rebalance like 40 times last year. Right? They basically had to start moving to cash. They had to do things to protect themselves and protect the value of each individual share on the index tracks. This one rebalanced, I think, 14 times, and 12 of those were scheduled. So it forces itself to rebalance at least once a month, which is a huge advantage. It takes itself back to 60-40 split at least once a month. 10% is a lot of volatility, right? So only a couple of times last year that it actually rebalanced because it was forced to. If you look at even like March of last year, March of 2020, the volatility overall in the market was like 20%, right? So you're talking about something that is once in a decade correction, and it's still only hit 20% on the volatility side, right? So you're talking about an index here that offers a 60-40 split, no downside, and a 10% volatility, which is something that allows it to have more upside, more alpha for your clients, because it doesn't force itself into a more conservative, not to get too deep in the woods, but forcing itself back into cash, basically, and less aggressively, very often, right? That's the advantage of a 10% volatility strategy. Here's a report we get. This is one from the end of last year. I should point out, let's see, the 2-year return, which is, I can actually have it right here. So hypothetically, a client, this is based basically on the strength of 2019 and then also 2020. A client hypothetically was in this product at the end of 2018. They opened up a 2-year strategy. Would be seeing 38.1% as a return, minus the 5.1% spread. So you're still talking about 33% over the course of 2 years crediting to a client. Now, one thing cool about this, and I think why this is going to be a rock star moving forward, is that it did, if you look at here, you can see my mouse wiggling. So over the course of 2020, with all its volatility, when all of these indexes were suffering, most of them were suffering, 90% of them were suffering, they're going to cash, they're going zero, or going to negative. On performance, this one did over 10%, right? So it's really designed to grab onto the market much faster and much harder than most of the competition. And what that means is more upside for your clients. This gives you an idea here. So same screen as before. You're talking over 1% more. Again, that's compounding. It's a 2-year strategy every year on average than the Barclays did. And then you'll see the low period as well. That low period is even with 7 out of 10 years being down, right? Pretty fantastic performance there. Like I say, this is innovative, simple, and transparent. Innovative because it's the first of its kind in the market. Simple, no caps or fees. Client just, they're really able to, in my understanding, talking to agents about clients, they're able to understand how this product works a lot more than some, let's be honest, overly complicated accumulation products. And it's transparent. It's based on real returns, right? I mean, this is, like I said, this is about as transparent as you can possibly get in the insurance industry for an index. Everything is out there. The way it works is very public. You can see the daily performance. And the ETFs that it tracks have been around for close to 30 years apiece. So I want to talk about, this one gets a little more complicated. So I'm going to try to talk at a high level over this. This is the Accelerator Plus. This is our income product, our flagship income product. It uses that Barclays Trailblazer we talked about. Currently, it uses that Barclays Trailblazer we talked about. So the cool thing is has really great. So this is apart from the income side of it. Again, it's a lifetime income product. Really competitive crediting strategies that are very similar to the Accumulator Plus. So you kind of get, what you're getting is you're almost like getting two annuities in one, right? Even when you turn the income on, you almost have like a column there for you have like an accumulation product, really, really good crediting historical performance, as you had seen earlier. But then you also have an income rider as well. Right? The fee is only 1.15%, which is about below the average what you typically see for this type for a performance-based income product. I don't want to go too much into how the rider itself works. You really have to walk it through on a case-by-case basis, but just know that it's one of the most competitive in the entire industry, especially if you can wait more than 3 or 4 years. It's very rare that I see, especially for younger clients, it's very rare that I see an illustration from another carrier that out illustrates this product. We have a unique feature on this one. So I mentioned on the accumulation product and all of our products, we have what we call an Mba Rider. So it's basically a way for a client to liquidate an account without penalty. Certain criteria are met. We have a similar, we call the income doubler, impairment multiplier, similar item on the, or rider on the other side here on the income products, where how this works is if certain criteria are met, especially 2 of 6 ADLs, the client can't perform 2 out of 6 activities of daily living, we will double the lifetime income amount that they would have been receiving until a couple things happen. Until the client no longer needs that and no longer meets the criteria health-wise, until the client passes away, or until the account value reaches 0. And when the account value reaches 0, the client will just continue to receive a single payout for the rest of their life. We're one of the first, I believe the first actually, to market, to offer something like this. I still think we have the best income doubler / impairment multiplier on the market today. The Barclays Trailblazer, again, this is important. I should have mentioned this earlier. Anytime you see the Barclays Trailblazer on one of our products, 100% guaranteed minimum participation rate. Okay, so for the course of so if you're in this contract for 10 years, the rest of your life, a client is never going to see below 100% on a participation rate for our Barclays Trailblazer, including on this product. Where that becomes important is that some carriers will offer very great upfront participation rates and crediting options. And then years down the line, they'll slash those. Very, very important on an income product because we just talked about how this one has great crediting strategies. So you almost have, the death benefit accumulation side, you almost have 2 annuities going at once. That is I think our competitive advantage in this product. Even in cases where we might lose out on having an income payment amount that is higher at a different carrier, typically you're going to see much lower crediting strategies. So you think about when that client passes away and the income stream is going to stop, talk about legacy and talk about leaving money to your clients, to the beneficiaries of your clients. Very, very consistent. We're in it for the long haul. It's very rare to see that on a product like this. The 14-year, up to a 6% investing premium bonus, 120% participation rate currently, and then that performance multiplier after 10 years. Basically, like I said, very great crediting strategies. Basically how it works is you get, however the account value grows, multiplied by up to 150%. It's going to get you an income base. That's important when you look at the illustrations to show you what the lifetime income will be for a client. Again, fee or no fee options here as well. Here's the 10, slightly lower bonus there. I'd say most people go into the 10. The way I want to point this out just because this is kind of how this works, how this product works. You're talking about the purple line here is the account value growing. Every step up you can see when somebody has received a dump end, right? They have an anniversary and they've seen growth in the account. Now that account value there is being multiplied by 150%. You get this top line. So this top number here is going to be the amount that hypothetically the client would be multiplying. So the longer you wait to turn on income, the higher the percentage is going to be. But say this number, $194,697 is the income base. At certain ages, the client might get 5% of that every year for the rest of their life, or 6% of that. It depends on how long they wait. So you can see the strength of this product and that because that is how that performance multiplier works. And it's very, very aggressive in the industry, especially with the crediting strategies that we have. So probably it's best just to handle it on a case-by-case basis. But just know this is, if you have anybody that's looking for lifetime income, this is going to be the way to go, especially for younger clients. not to beat a dead horse, but here are our participation rates here. Again, very, very, very high for an income product, especially one with a historical performance, excuse me, of that Barclays Trailblazer. And then the 1.25% fee works exactly the same way as it does in the Accumulator Plus. Let's just go over an illustration here. Age 60, I will say this, we do see a lot more younger clients going into this product because they can wait. And if you can wait, like I said, probably more than 3, maybe 4 years in this product, it's going to be tough to find an illustration from a competitor that beats this. So this is a 60-year-old, $250,000, going to fund their own pension here. So working our way left to right here. And again, I know this is not probably the forum to go super deep into the illustrations here, but you have a $250,000 initial premium. There's the most left arrow there. The next arrow kind of down to the right of that is the account value after 10 years, right? So you had some excellent growth in the account because of that Barclays Trailblazer, and obviously the fee has been taken out of that. Now the next arrow over is simply that $462,051 multiplied by that performance multiplier after 10 years, that's 150%. That'll give you an income base there of $675,895. So the income base is growing much, much faster. And the longer you've waited, it's growing even faster than the account value, which is kind of the benefit of a performance-based income product like this. Obviously, you're taking it times 5% because of the age of the client, 70 in this case. And you're getting the next column a guaranteed withdrawal payment of $33,795. That's guaranteed for the rest of their life as long as they don't touch the actual, they'll start taking more money out than that in the account. So that's the guaranteed withdrawal payment. The next column over is enhanced guaranteed withdrawal payment. That's that doubler we talked about. In certain scenarios where a client has health issues, that'd be possible to access that. But work our way down here. When you're talking about, 71 years old, they're taking almost $34,000 out a year. They have, this is the next arrow down there, the age of 80, taken out on a $250,000 investment, they've taken out $371,745. But because of that account value, because of that, the growth of that Barclays Trailblazer historically here, they still have, the last two boxes here, it's a death benefit. So it gets back to what I was talking about, almost having 2 annuities in one. Really great crediting strategies. They've taken, almost $400,000 out of the account and still have almost $400,000 in the account. Right? If you look in this scenario, basically the amount of money taken out in total equals the remaining account value. If they passed away at age 80, if they would have, I would just say, quote unquote, beaten the insurance company, they would have received more money than they paid in. And their beneficiaries are going to get a decent payout too. So that's really the goal. I think the advantage of these performance-based income products is being able to offer that kind of flexibility, those type of benefits to a client. Computer's so slow. One thing we do, I want to mention this, this is common. A common objection we get on the 2-year strategies, and again, the 2-year strategy is going to have the highest upside potential. If you want to hit home runs and grand slams, use a baseball analogy, the 2-year strategies are priced to do that. The 1-year strategies are going to be your singles, doubles, and triples, still very, very competitive, at least for the products we offer at F&G. What you can do, this is very, very popular, is you can split your tickets. So if your client says, oh, I don't like a 2-year strategy, but they want to have the highest upside, they can get the best of both worlds. So you put $100,000 into an account, you open an account, put half that money into a 2-year strategy, half that money into a 1-year strategy. At the 1-year anniversary, you move that half money that's in the 1-year strategy into the 2-year strategy. So what that does going forward is you get what we call laddering, you get a laddering effect. Every year after the first year, you get the power of the 2-year crediting strategies every single year, right? So it's kind of one foot in front of the other every year, right? There's the first 50% is going to credit at the end of the second year. The second 50% is going to credit at the end of the third year, and so on. So I just want to point that out. It's common. That is a way to get around that objection of I don't like a 2-year strategy. I don't like receiving money only every 2 years, but also give your client the best upside potential. And I want to point out, we have a really awesome tool called SalesLink. It's a website for us, for producers, excuse me. You can run illustrations. One thing we have that I didn't realize until very recently, nobody else really offers, is a suitability tool you see on screen here. That is a fantastic tool, especially if you have a client in the office and the client says, I have $100,000 liquid. How much money can I put it into annuity at F&G? Or they have a question about, will F&G take this? That tool you can pull up. It'll ask you questions about the client, complete their suitability. It'll spit out any errors or anything that it's kind of quote unquote violating, right? Any rules that it's violating. At that point, you can come and give me a call. We can talk about maybe if there's an exception that can be made, or a call to explain what exactly is being asked there. The power of that is that you don't end up submitting business for your clients that is going to end up getting rejected. Right? That could still happen, but this is a tool that you have to go over with your clients and really get an idea of what F&G is, their appetite is for this client's funds to receive, what F&G is thinking as far as suitability, things like that. I will say that there is flexibility we have. Like F&G is maybe the most flexible carrier on the market to make exceptions, to make things happen for your clients. I will say that. However, there are guardrails, of course, that are in place. But this is an excellent starting point to get an idea of what we're trying to avoid is for you as agents and as producers and as advisors not to have egg on your face, right? So this is a tool we offer you to help start the conversation with the wholesaling team and get an idea of where the client is and what we'll be able to do. So we're not going back and forth for different paperwork and things like that. Illustration software. Yeah, here we go. Training, we do provide, use Success CE. Not sure, Jeff, how many people on your team are all up and running with and good to go with state requirements, things like that. But we have the ability to use Success CE launched out of SalesLink here. First of all, obviously product training. You need to take product training to sell our products, but also there are AML, there's questions and guides about state 4-hour training, things like that. So we try to provide an all-encompassing website here for you as an agent portal. You can access your existing business. You can access the marketing materials. You can access applications and everything like that. So I think it's easy to use. I think you will as well. That is the end of my slideshow. I wanted to, in about 45 minutes, I wanted to leave at least 15 minutes here for questions. I know there's a lot there. Talked about 3 very different products. But please, let's open it up and let me know what you got for me.
Well, we had one question, Matthew. It was, is
Sure.
the Accelerator Plus replacing the Performance Pro? Or is that just an additional annuity? It's a separate one altogether.
Additional annuity, yeah. So Performance Pro, Performance Pro is an interesting product. It has so it's just a different way of going about the income base. You get currently 2.75% plus whatever your index choices do into the income base. Accelerator is you kind of see that on the illustration. I can go back there. It steps up a multiplier instead. So instead of giving you just a simple bonus every year on what's credited, it has a multiplier. That's why you saw on that chart where the account value grew so much faster at the end of 10 years than the income base grew so much faster than the account value. That's really the strength of that product, especially if that Barclays really takes off like it has historically.
Got it. That's the
similar
question. Any other questions? I'm just wanting to see if they have any more. I don't have any other questions, but that was a great job, Matthew. Thank you so much for your time. That was awesome. I appreciate all the time and effort you went through.
Thanks for the opportunity.
Yeah, and if anybody has questions, they can just email Brianna or myself, and then we could get it over to Matthew. That'll make it much easier, so we could tailor your questions to whatever you're asking. All righty. Thank you guys so much. Matthew, thank you for your time today. We appreciate everything. Everybody's saying
thank you
on the chat here.
Great.
Sounds good, you guys. Have a great day, everybody.
I'm here as a resource. Some of this stuff is very complicated. I'm here as a resource. Whatever you need, please let me know, okay?
Thank you, guys. Thank you so much, Matthew. Appreciate it.
Take care. Thank you.